There you go, we're up and running. I know that you guys have been covering a bit on central banks, but I thought I'd just bring gold up to start with because we're getting to a really interesting point now. Sitting down right on the, yeah, it's breaking the flag now as well. It's just making it a bit, it's making it hard to go. Part of the problem, and this is what you'll often get, is when you get delta rising, you've got the technical structure, you've got the reason to go down, but the delta's rising. I don't think it means it won't go down, but it's just making it very, very difficult to do it. So if you do try and sell, why is it not selling? Oh, that's what I was trying to click. Oh, there we go. That was where I thought it was going to go to. Let's see. Right. That could be the low. That's what you get for trying to explain something and being late to the party, because you turn replay on. So I turn replay on, it switches everything to trade off the replay, so then it's not executing on hit. Anyway, the point I was originally making was, and the reason for pointing this out is this is a trade I've got myself caught out on in the past, particularly if you're not part of the big move. We all know gold has dropped miles today. If you're not part of that, it's a real easy one to start getting tempted into, oh, maybe it's a buy down here. Surely it can't have gone that far. It's starting to look like it possibly is. But the reason being, you start looking at the delta going up and up and up and up and up, and you're like, oh, this is probably a buy now. It gets really tempting. The difficulty you have in that situation, and this looks increasingly like it might be. There we go. The difficulty you have in that situation is it's such a bearish market, and what's actually happening here is delta is going up because people are essentially buying into just this weight of passive sellers. The sellers are just sitting there on the offer, and any bounce they sell it, any bounce they sell it, any bounce they sell it. So yes, you're seeing delta going up, but it's just effectively just meeting a wall of sellers that are progressively shifting down. I put the ladders up initially because I was going to talk about the breakdown, which isn't missed it now, which is frustrating. If you've missed it, this is then quite a tricky one to get back into. You've still got, and this is one of my favorite things on directional moves, that moving average. That's a 1 minute exponential moving average. It generally holds quite nicely below that, as you see up here and here. It's touched it there. That's the only time it's really gone through it. So you've got that as a way to kind of either trail your stop or try and get short off. But the bit I was looking at was this break of flag. Go on. Is it 20 EMA? 20 EMA on a 1 minute chart. I'm not fussed on moving averages on longer time frame charts. They're too vague, but on a short time frame, the whole idea of it is it moves very close to the actual move or to the actual market. So it's a good place if you're trying to hold on to something. When it gets tempting to go, oh, I should probably take that, you can just trail your stop behind a moving average. If you don't have a target, I'm not a big advocate of a runner, but this would be a way that you could have a runner, because you could then go, well, the moving average is my resistance or my stop, put it behind that and then let it go. So we've started to get the move. You've got that sort of steady breakdown. I don't think this goes up. If you're going to try and play the move up on the delta reversal, I'd be looking at 75. If you can break that, then there is some scope, and you could get, at least you would think, a reasonably quick sort of liquidation move up. That'd be what I'd be looking for. But I wouldn't be expecting this to be a break 75, reverse, we're going up here, we're going all the way up here, that kind of thing. It could be quite a quick move. You could get 50, 66 out of it reasonably quickly. In fact, I wouldn't be overly surprised to possibly see even 100, just because when volatility picks up, the scope of movements there, gold could do it. So eyes on 75 now, particularly with that failed break of the low. Right. And that was the first thing I was going to touch on. What part of the reason why the delta is going up is the absorption on the way down. If you want to go and have a replay of something, have a replay of gold from the breakdown from probably 2686, somewhere around there. That's probably the main point. Yeah, this area here. So actually it's 2701, so about 1245. If you're gonna have a look at gold from 1245, one, it's a good one to go and replay because it gives you this nice break towards the downside. But also keep your eye open, try and spot all of the absorption. What you're getting is people coming onto the offer with 30 or 40 lots and it trades back and it fills them and it just comes straight back and straight back, straight back, straight back, straight back, and then it pushed down again. This is a really, really good example when we do a bit more on like momentum on order flow stuff. Really good example of a market creating little pockets of low volume and holding them, like almost to the tick. It did it in the low 80s. It then did it around 75 as well. You can add under each of those and try and play that movement, or sort of play the continuation of the movement down. Excuse me. So that's one to watch out for. Each of those, you can see the green lines. The original idea was getting short up there and playing that one down. And then this takes us on to kind of what I was just talking about, the implication of this. With all of that rising delta, you are now left with a reasonably straightforward kind of implication. Either all of these passive sellers get overwhelmed, you get above 75 and we put in a bit of a reversal, or all the people who've been hitting into them and hitting into them and hitting into them and trying to get the break get turned over and you get a liquidation kind of final splash down at the end. So I think it's one of those two. If you're short from, who knows, up here somewhere, you're waiting for that rush down. When you get that rush, that's where you get out. If you're short from up here somewhere as well, if it starts coming back up above 75, you've got to start thinking, do you really still want to be in this? And just be very aware that if that is the case, there's probably a fair few other people thinking something reasonably similar, which is what presents the risk that if you start getting up and you see this little area of low volume, that's held really, really cleanly on the way down. You start getting through there, a bit like that S&P one where we looked at the reversals yesterday. You have the possibility that everyone else who's short, thinking, yeah, this is gonna go, they've just seen themselves or seen this reverse 100 ticks in their face, they may start getting out of that quite quick. You run that possibility of this fast sort of liquidation move towards the upside. So something to think about there. If you want the long, I think that this is a reasonably straightforward area that you can buy from now, and you're looking for it to be pretty quick. I wouldn't look for it to be massively sustained and expect this to be a long, long, long move up. So if you are someone who likes a reversal trade, that's probably the place that you want to be interested in. Sort of 75 to 76 zone.
If that was a full-on reversal, Rich, because of the volatility we got today, you want to see more of a volatile exhaustion at the low end?
You would want to. That would be the ideal. That would be nice to see. But yeah, you've got to look at it like that. We'll do it in the later weeks on like strategy. That's the perfect scenario. Yes. Does it mean that it doesn't work because it didn't do it? No. That's the way to look at it. Like, if it's going to go up from here, there's a number of ways that it could do that. Yeah, if it had a proper washout of those lows, you might be feeling a bit more confident on it and a bit more happy to go, yeah, that's good. I can do this and I can stay in that one. But if it doesn't, or as it hasn't, I don't think that really changes much. It's just people, ultimately, the people who are short have still seen the chance to go and it's come back on them. Yes, it's not splashed down. Oh, also, if it had splashed down, you probably wouldn't have so many people short still who are going to have to liquidate their shorts on the way back up because they would have seen it splash and gone, yeah, that's good enough, I can get out. So that's the way I try and look at that. Right. Okay. Not entirely central bank orientated. But this is a question on DAX. In fact, I haven't even got DAX ladder up. Why would it not let me do that? Right, let's see if we can get DAX ladder up. Oh, for goodness sake.
S&P's at all-time highs, right?
Well, cash is, yeah.
Yeah.
Right. Okay. cash is, yeah, because it will have, is it just, well, it's not opened yet. So it's likely to open record highs. Okay, got a question on DAX. This is actually a replay, so it's not where the price is at the moment. Is there anything common or typical of the DAX that you might see on a price ladder? Number of contracts going through at relatively low bids and often straddle the price. Sometimes it's quite skippy and jumpy. I would completely agree with your assessment of it. I don't think the DAX is particularly good to trade anymore. There's nothing in particular I would look for, and in a sense that would apply to everything. There's no special thing that I expect to see in the S&P or the DAX or NASDAQ or whatever market it is. I don't expect to see anything specific to any market. Or just it's gold. Someone's trying to chase it up with larger orders. So I would say on the whole, I would generally just leave it alone. I know there's a lot of attraction towards the DAX. The reason that people are attracted to the DAX is it's a 25 euro tick value. So if you bought it here and it goes up 5 ticks, it's 125 euros. You go, wow, look at that, that's wonderful. 5 ticks in the DAX is nothing. The difficulty is the stuttery nature in which it moves. You can be sitting there and it's 5 ticks away from you, 10 ticks the other way. There's a complete lack of flow. Unfortunately, that's because you now have the mini DAX, which is small but not too small. So the mini DAX is 5 euros, the big one's 25. So you could trade the mini and you can still make some decent money in the mini. So what it's done is taken the original DAX volume and just split it in half, and it's basically ruined both of them, unfortunately. So I think your summary is pretty bang on. On the whole, I would stay away from it, if I'm completely honest. And that's coming from somebody that was my main market for years. I love the DAX and it's rubbish now. You have to kind of accept that. Not everything's good forever. We'll touch on the S&P as we get towards the open, so someone remind me. There you go, I'll put my clock over there so we can see the time. Okay, I know there's a fair bit on central banks. I'm actually surprised there's very few questions on it, but if any do pop up in the chat, throw them in. Maybe everyone's tired after trading the election yesterday. Couple of things for you guys then to go and have a look at or do going into the Fed, because it is the Fed tomorrow. We'll do prep on the Fed tomorrow morning. I'm tempted to say we'll do it from 11 rather than from 10. I know on the calendar it says 10, but I'm tempted to say we'll do it from 11 to sort of give people a bit more time if you're not in Europe to actually be around. Appreciate that's still quite early, but if you're Eastern time, that's 6 a.m. So it's perhaps not quite so bad. But a few things to go and have a look at. One of the things, or one of the most important things when you go into any kind of central bank rate decision is to understand pricing. Because what they do in the decision is ultimately contingent on whether it changes pricing of anything. So at the moment, and the best place to go for this, if you Google CME Fed Watch, fantastic website. I think I've got it, I might show you a little bit more of it in a moment. It's a fantastic website. You can go through and you can look at all sorts of different information on the Fed. The main thing that it does is it shows you the probability of a certain rate at a future meeting. So this is what the market is pricing. The way they work it out is from the Fed Fund Futures contracts. So you take the Fed Fund Futures contract, in fact I can show you. There you go, that's your Fed Fund Futures. So that's the December Fed Fund Futures contract. So what you can do from that is if you go 100 minus the price, that gives you the implied rate at the expiration of this contract. Thing you have to bear in mind, the expiration of the contract may not be exactly at the same time as the Fed, and that's why you may see a discrepancy between what this suggests and what the actual pricing suggests on here. They've calculated this by considering the number of days left and the impact that has on pricing. Roughly though, it will still tell you. So what this is telling you, 100 minus 95.49 is 4.51. So that suggests interest rate of 4.51. Current rate is 4.75 or 4.7525. It's expected to move to 4.5 to 4.75. The Fed works with a range, so they have a range of for their interest rate rather than just a straight number. I'm not going to go into the specifics of that because it doesn't really make a difference. You just want to know the main number. What this means is that the effective rate, the actual rate that the Fed tries to keep the market at is, or will be, 4.625. So what you can take from that, if this is going to be the rate in November, this is saying that in December it's going to be 4.51, then you're halfway to the next rate cut, or to the next move, if you will, because the next from here would be 4.25 to 4.5, the midpoint being 4.375. So this then implies that you are basically halfway, i.e. there's a 50% chance of a rate cut in December, priced from this. The actual pricing, because it factors in the time until the next rate cut, comes in at actually 68%. So you're slightly more than that. So that's the way to do it. So these are the ones to watch, the Fed Fund futures. Tomorrow, I'd keep your eyes on that one. Go on.
How many months ahead do you want to look at average? Maybe next month?
Well, there's no point in looking at November, because the November is exactly where it's pricing the market to be. The November is not going to tell you anything, because the November Fed Fund futures are only going to move if they don't cut 25. If they don't cut 25, you don't need to look at that to know that it's a massive deal. So November doesn't matter. What does matter is the market's perception of whether they will cut again in December, because that's what the current probabilities bit showing, that's where you're going to go: September, January, March.
Where do you get that chart, Rich?
Sorry?
Where do you get that chart from?
CME Fed Watch. So if you go on the website here, where's it gone? Lost it. Here we are.
Well, the further out you go, the more skewed the odds are.
Sorry?
The further out you go, the more skewed and spread out the...
Yeah, the more skewed, the more spread out they'll be. So that's what you can do. If you go probabilities, what it show, there you go. The probabilities will show you a greater dispersion, as in if you go and look at, say, the next month in December, you've got 32, 66 and 0.6 as well. Basically because they're pricing in the possibility that they could do more than 25 in December, whilst unlikely the market will price that to some degree. The way they work that out is from looking at where the January one is as well, because the January one would then give you an indication as to where you would be in January. So if there's a possibility of more, the January rate would have to factor that bit in. So there's a lot of maths that goes into the sort of specifics of it. But the simpler way is if you go on to the aggregated, that just gives you a straightforward, it's going to be one or the other. So basically anything that's marginal at lower rates, they just push into this, and anything that's higher and marginal, they push in as well. So that's how you get that rate as it is there. And then there are all the contracts, the Fed Fund futures contracts that it's using. So what you can take from all of these is that if you see the numbers going up, rates are going to go down. And that then is shown here. Quite a distinct difference compared to where you were, say, a month ago and where you were in August. This was showing that come December of next year, we were going to be down here, sort of 2.5, somewhere like that. So there's been a lot of pricing out, and that's the thing that you're interested in, the way that those things start to change. That dog back on its way down now. Squeezed everyone out, and down it goes. So go and have a look at that. The straightforward bit is there. So that's then what it's showing in terms of pricing for tomorrow. 99% now. That is kind of, as guaranteed as you're ever going to get. And then that gives you December. And it shows it, there you go, etc., etc. You can go all the way out. Basically, one of the big things that you want to know for tomorrow, go and read the preview that I sent as well, is how far are they going to go on rates? That's the bigger question. We know what they're going to do tomorrow and Thursday, is how far are they going to go?
You
mean like increasing the interest rate?
Cutting.
That'll be in the policy statement? Or?
No. They're not going to commit to it, because if they commit to it and then things change, they've then got to go back on it, which is a credibility issue.
It's just solely going off the odds, or the percentages?
Well, no, what you're going off is what he talks about in the press conference. Go on.
Does it have anything to do with the terminal rate?
That's the question. When people talk about the terminal rate, that's the end point of the cutting cycle, basically. They called it a terminal rate on the upside as well. But yeah, the terminal rate's the upside of the cutting cycle, or downside of the cutting cycle as it is at the moment. That's something that people are going to be wanting to know. The expectation is that you're going to get one more cut this year. So you'll be 425 to 450 plus another 100 next year. So 325 to 350 is about the consensus for that. But that's what you're going to try and find out tomorrow. He doesn't have to answer. He's pretty certainly not going to answer either. but it's the way that he answers. If he wants to imply something or, you know, discourage it, suggest that they need more time, any of those types of things can lengthen. Well, you can either elongate how, you know, the cuts over time, which effectively has the similar kind of impact as not cutting as much because you're spreading them out, or you could just not do as many, which is the other thing that they could do as well. The other thing to do is go and have a look at the dot plot. I'll talk about that in a minute because you're right on the S&P open. I think this should be a pretty interesting one. So ultimately, this is a question of, is this just a massive gap and go record high, off you go to the races, or not? There we go. Whoa, straight down. That's exactly what I was going to say. I think that looks like a profit take. There you go, that's a pretty swift drop. That said, it's a swift drop, it's done 10 handles. It's not exactly gigantic. Yeah, bearing in mind how far we've gone overnight, I don't think it's absolutely massive. But yeah, it feels like a bit of a profit take. Like I said earlier, it's hard to be surprised by people who have seen this go up nearly 200 handles in the last day, not taking some profit. And if it wasn't for an election and any of the other stuff out there, you'd look at this and technically you'd be all over saying that's a sell. You have to kind of balance that against, do you really want to sell this because of the election? Incidentally, 27 I think was the previous high. So there's your gap close. So if you want the gap and go, that's the way to try and do it. And you try and buy it down there and you play it like that. Otherwise, I'm still looking at that thinking 15 to me is still the important place. That's the top of the previous range. I still think that looks all good down at 15. It's just a case of, you know, what it's going to do now. Unless you've got a really, really strong conviction as to what's going to happen, or you're going to go for the real kind of simple, I'm going to play the gap close, put my stop at 10 and see what happens. This is probably not the best time to be getting involved. It's super volatile. You've got a load of people scrambling around in the aftermath of what happened yesterday. How involved do you really want to get? It may be more a case of let people get excited and rush around and do whatever business they've got to do and then play something after that. Yeah, if that is it on the downside, then you could look at this as an opening range of whatever that was, 42.5, 41.5 to 25, and you play the break of the range. Just because that's just let everyone chill out a bit rather than sort of rushing in. Like I say, you could have just gone for the 27s and then, yeah, that looks good enough. Interesting, we're straight back onto these 300s chasing it around. There was one chase that up, now you got it on the offer. I'm still not entirely sure what they seem to be up to, but you're seeing a fair bit of that. Yeah, come on the bid, now they're on the offer. Like I say, we're still basically stuck within that first 1 minute candle. So I think it's just time to settle down. It's a really easy one to get carried away and go, oh yeah, it's all go, and jump in. And before you know it, you've been pinged here. Huh?
I think they traded them for 100.
Well, that's a good thing to see. They're willing to go for it. Yeah, that could be it. That could be you had the washout, you had the test back, and now it can go. So we're kind of looking at 41 for the break. If you can break 41, ideally you kind of want this to not do it too quick. Yeah, a bit more time, trade in this area. Yeah, let people kind of just chill out, think about what they want to do and then go for it. And then you get a break of 41, could be a decent trade. We'll see. The good thing is volumes are massive compared to normal, which is great, because if it's going to do something, you can at least trust that it will do something, which is what you want. You don't want to see this just drifting around with light volume. Yeah, you look at the volumes because of the time change. This is still factoring in the time change, but you're way over 5,000 contracts a minute so far, which is very, very positive. So good news in that respect. It's just now a question of, well, where are we going to go? Sorry?
$1 million question.
Well, I doubt it's going to be worth $1 million. but there is a question. So we'll see how it does it. But for it to chop around up here at the moment, I can't say that you should be overly surprised by that. And now I think you've got a reasonably straightforward break the range. Whichever way it breaks, you've probably got some direction, whether that's 10 handles down to 15 and then you find out, or whether it's break 40. If it breaks the high of that range, you have to look at it and think that's it, record highs. Go have a look at the dot plot. I'll bring that one back in just a moment. So here's ZQ. Oops. Right. With the dots on the Fed, we're not going to have dots at this meeting. You only get them on a quarterly. It's worth, if you can, track the dots over time. That's as soon as they started to raise the dots. Bearing in mind, we were at zero rates post COVID. Once they started doing that, I started tracking the changes in the dots, just so you could see historically how they've moved. So worth doing. I could send that if anyone really wants it. The chart is useful because what the dot plot shows you is where the Fed thinks rates are going to be at the end of each year. The way they do this is each member effectively votes or puts in where they think rates are going to be, and they show up as dots on a chart. And your dot, as it is termed, is the median dot. So it's the median price or the median number there. The red dot is the market pricing. So the red dot is where the market thinks rates are going to be based on Fed Fund futures. The blue is where the Fed has said they think rates are going to be. Now these things fluctuate over time. You look at what we've seen so far from last year: 5125, 4625, 65, 5125, 4375. So it's taken a big sort of shift around in June and September this year for what they expect rates to be at the end of the year. So they can always fluctuate over time. What this does suggest is that the market does not think the rates are going to go down as fast as the Fed. That's a long way from where we used to be. A little while ago, you had it looking like that. So massive, perhaps that's a bit extreme. We won't go down into the 1%, but certainly something like that. So there's quite a difference that you're seeing at the moment. We're not going to get anything on the dots, but you need to understand it. What is likely to come up tomorrow, though, is a question for Powell on does he agree with the dots? I.e., what they've said they're going to be, does he still believe that that is the case of what they're going to do? That's the bit that you're interested in tomorrow. He has so far, and the other thing that you need to do, and I put it in the chat. I put the preview in the chat. Go and read the preview. What you're interested in between any central bank meetings is what has been said by the different members. Whatever they say can become a guide for what they're going to say in the press conference. Powell, on the 30th of September, I think it was, essentially said, we don't need to rush, and basically we're moving in line with the dots. In fact, he did actually say 2 more cuts this year, unless anything specifically changes or dramatically changes. So on that basis, particularly with a meeting like tomorrow, where you don't have dots, so there's one less indicator or one less thing you could go, change, click. This becomes what I would call interpretation meeting. It's more likely to fall onto his press conference and what exactly he says during the press conference. That's the bit that we're interested in. One of those things is going to be a question of the dots. Do you still believe that the dots are correct for not just this year, but also for next year? So next year, they're implying another 100 basis points cut. The market doesn't think so. So is it the Fed's wrong or is it the market's wrong?
When do they expect the 4.25%? At the end of the year, or is it like a medium? Or?
Well, it's 4.375 is what the dot is. So that would imply for rates to get to 4.375, then it's got to be 425 to 450.
By December 2025.
Well, yeah.
So 2025, by December 2025, we'll have rates at, well, the market's pricing 3.75 and the Fed 3.25.
3.375, yeah.
So that's more long-term.
Well, there's a discrepancy that basically the Fed's saying we'll cut 4 times next year, and the market believes that they're only going to cut 2.5. Obviously, you don't get a half cut, so 2 or 3 is the implication. Obviously, lots change throughout the year, and that's the bit that you're trading. You're trading the way the pricing changes rather than what they've said. Because if you go off what they've said now, these things won't be the case. If you look at the 2024 dot at the beginning of 2022, The Fed was saying rates at the end of this year will be 2.625, i.e. down here. Yeah, but that's where they thought rates would go. Not because they've gone up and come down, they thought that would be as high as they're going. And then they go up and up and up and up and up and up. So the dots will always change over time. Significant changes in the dots are often a bigger deal than the actual decision itself, because most of the time when you get to the rate change, you know it. That's the goal of a central bank, that they don't want to surprise. They want what they call a good transmission of monetary policy, i.e. what is communicated is what they do, because that doesn't surprise anybody and people factor that into their decisions. If they say, oh yeah, we're definitely going to cut rates to here, and then they do more or less, that creates a surprise. That affects it affects financing of stuff. So whilst, for you and I, it doesn't really make a great deal of difference, and from a trading perspective, it's wonderful. For a lot of businesses, government, anyone borrowing any money at a large scale is suddenly affected because their borrowing costs could shift quite significantly. That's not what they want to do. The June 2022 Fed was quite interesting in that respect, that they did actually do more than was expected. They did 75 versus 50 expected.
It didn't look like we got too much of a reaction. Like, it took 7 minutes to get a bit of something. Is it the replay?
The one on the replay, if you do June 2022, the big feature of that one, I don't think I've got it on the board up here. The big feature of that was that markets sold off into it. And then what you ended up with was the Fed had originally in May said, we'll do 50 in June. I think he said something along the lines of 50 is on the table. They then, because markets sold off, or bond markets sold off into it on the back of CPI in Michigan, and then a new Wall Street Journal piece, that then effectively priced in 75, and the Fed went, okay, we'll do 75. They did 75, and then Powell in the press conference said, don't expect 75 to be common, or words to that effect. So the market then prices out any more, because what happens is when you get, let's say, 75, that's a big change from what you've been seeing previously. So the implication is they're now willing to do 75s. So the market starts to price 75s in going forward. So everyone plays it like there's more 75s, and then he goes, aha, but we're not common. So don't expect more of that. And that's where what you got was this huge reversal in the equities, because he basically said, no, don't expect that. He then did 75 in July and September and October. Because what they did was then kind of walk that back and went, well, actually, in light of recent data, 75's on. So, sorry? 2022 was nearly as good as COVID year because of the amount of stuff like that. Where we are now, the thing that's going to, or the possible impact that could change, because like I say, we're not really interested in tomorrow in terms of the rate change. December's the one that you're interested in. What could change December is the data that we get until then. We just had payrolls, which was terrible. We've got CPI next week. You're then going to get December payrolls and December CPI before the next Fed in December.
Payrolls is unemployment rate? Or?
Yeah.
So
the one that we saw on Friday.
They're saying it still remains low in the last policy.
Yeah.
So it's still low as well.
So that was terrible. If that's not a one-off, and that's the thing, that could be a one-off and they could go, yeah, this is because of the hurricane. If it's not a one-off, that suggests that you could actually be seeing quite a decent downturn in the economy, which could spur an acceleration in rate cuts. That's the bit that you want to try, or you're going to try and work out. Now, it won't just be like that, because if, let's say, payrolls is bad next time, there's still the CPI data to come as well. So it could still be seen as well as it's still okay. We shall see. But that's the stuff that you need to focus on now. The payrolls and the CPI data is very significant, because that's the chance to find out if the Fed will do 25 at the next one, or could be willing to do 50, or do nothing.
In regards to that, Rich, what are the main data releases that are important to the Fed? So payrolls, CPI?
At the moment, payrolls and CPI. The Fed's main judge of inflation is PCE. The PCE data almost never moves the market though.
But the Fed reacts to it.
That's the Fed's source for inflation, but the market never reacts to it. Why? I don't know. There's so many other factors that come out on that release. I think that's part of it, but you don't really get too much reaction. So the S&P's gone for it now, isn't it? It's back.
15s, 13s.
Yeah, that's the other place. I think if it's going to bounce anywhere, this is perhaps it. So we shall see. But at the moment, it's pretty heavy selling. So yeah, that's where you need to watch data in the in the upcoming ones. The bit that you asked about earlier, Jay, on the language. Best place to go for that is if you Google WSJ Fed Tracker. What they do is they give you the statement with the previous statement as well, i.e. the pink is what was deleted from the previous statement and the green is what's new in the current statement. So they kind of mash the two together. You can click hide changes and it goes away. One thing on that though, make sure you screenshot it and save it because each month this updates, there's no archive of it. So once this is gone tomorrow, you won't see it again. So screenshot it.
Is it pretty much instant as soon as the...
No, it's probably a minute or two afterwards. Yeah, I would say
It's quicker than we can do it though.
it's quicker than you'd be able to do it yourself, but you don't need to do it yourself. You just need to know the key bits that are changing. So from that...
You don't even read it, you just look at what's highlighted.
Yeah, that is the goal of it. That you should have certain things highlighted. You know what you want to see change.
How do we access it as quick as possible? Can we get it like a pop-up or something? Or
What's that?
This statement, policy statement?
You can get it as fast as it hits the Fed website.
So you just got to refresh it.
Yes, the better way or the better approach. Well, this S&P doesn't like it. I'm quite surprised at that. The better way is to use Reuters or Delta One, something like that, because that way you can highlight it. The way that it works in terms of the release of this type of stuff is the statement will be sent to the main news wires, Wall Street Journal, Bloomberg, Reuters, etc., etc. When they get it, it's under embargo. They are not allowed to release that information until 7 o'clock. What they can do though is read it and write the headlines that are going to come up on your Bloomberg terminal or Reuters or whatever it is. At 7 o'clock, they click the button and the data comes out. There may be other rules around it and the specifics of how that mechanism works, but that's the essence of it.
And the market reacts instantly to it, kind of thing?
Yes. Yeah, that's the thing that you're watching out for. Whether you get that much reaction is debatable tomorrow, but there's a few key things that you need to look at. So what you're trying to do is simplify the reading of it. If you read all of that, I reckon that's what, 2 minutes of reading, you've missed it. It's 2 minutes if you're me, because I'm really slow at reading. You've missed it, it's all gone. So what you've got to do is work out what are the key things, because a lot of this is mentioning something, then mentioning how something has changed. So you don't need to know the whole wording of recent indicators suggest. You don't need to know that. You need to know economic activity has continued to expand, so that hasn't changed at all. Jobs have slowed rather than moderated. Again, these are not the major changes. Probably tomorrow, this is going to be the only area that changes. So effectively there's 3 things that you get in the first paragraph. Economic activity and then its qualification continue to expand. Job gains and their qualification recently was slowed. And then inflation. And inflation has made further progress, but remains somewhat elevated. So they changed some of the language on that one. The subtleties in language change matter. Previously it was eased over the past year and remains somewhat elevated. Now it's made further progress, and that use of made further progress rather than previously it was has made, what was it? In recent months there has been some further progress. So rather than there had been some, it has now made further progress.
You could also take that made further, how much further? That could have just made like...
But it's more than it had. That's the implication. By doing more, it has now potentially done what it needs to do. Which leads you then to the conclusion that, well, if inflation has made further progress, you can now justify cutting interest rates. But you're not going to cut interest rates if you are still seeing inflation at somewhat elevated levels. Somewhat elevated is a new phrase that came in previously, because prior to that, inflation remained elevated. That was the phrase. So inflation remains elevated, then it becomes somewhat elevated.
Is that even a real word? Somewhat?
Yeah. It quite possibly could change. This is the kind of thing that if they change that tomorrow, and if they say that inflation has made further progress and has now, they probably couldn't say has made further progress and something, but they could say inflation has moderated, which is a common phrase they use. That would take away remains somewhat elevated. So if remains somewhat elevated disappears, they're basically saying we've done it, we've got where we want to get to. That could imply another rate cut or a bigger.
I'm sorry, Rich, but what they're saying there is what we've done in the past is kind of working, but we still need to do more.
Yeah. So this is what I call the sort of current situation. This is the bit that goes into why have they made the decision they've made.
And it's always the first paragraph.
Yes. The good thing with the Fed, it's standard. First paragraph, then they talk about risks, then they talk about guidance. And it will change over time. If you go back and look at previous statements, they've had slightly different formulations, but usually if it's going to change, it will change when policy changes. So this was quite a big change from the July because they actually changed policy. So some of the structure shifted as well, that normally they wouldn't talk about. This first line here is their mandate, i.e. what they have to achieve.
Could you use that as an indication? Like if you open up the statement and you can see that just from what you've recently seen, you've seen the format change, you just straight away know that policy changed?
If the format change comes without a policy change. If the policy changes, it doesn't matter what they say on here. This was probably the biggest change in statement for months. Doesn't matter, because if they change policy, the statement must change because it can't stay the same and have the policy change with it. So yes, but it ultimately doesn't matter. With the ECB, that can be slightly different, and there is a little bit more scope for it. Right, I'll talk on Darius's point in just a moment. The next bit they will talk, and this is a new line, so entirely new line. This is the kind of thing that is useful for next time. Has gained greater confidence that inflation is moving towards target. That's really useful because by having that, you now are looking for the change in that. So that's your new line. It's all right. I can't imagine they're going to change that massively. If they gained greater confidence last time, perhaps they have even more confidence. They could change it, and it's what I call a tense change, that they're changing the tense of the wording. So it could be, rather than gained greater confidence, the committee is now confident that inflation is moving towards target.
When the committee is confident, what does that mean? What does that imply?
It implies that they don't need to raise rates any further in order to get to the target of inflation or the target inflation rate that they want. So they don't need to do anything more. Or with that being the case, they can now start to cut rates.
So when they're confident in something, they've done enough kind of thing, or they're doing enough?
Yes, that the balance of what the next step is now clear. As in, it's not going to be a rate hike. It's just a case of how many more rate cuts. What's happened in recent years, or in the last few years, is that with inflation going up, what they do is they then raise rates. So the raising of rates pushes inflation down. The way it does that is because it stops people spending money. If your borrowing costs have gone way up, your willingness to spend money goes down. You're certainly not going to borrow as much. So that then dampens inflation. It also incentivizes you to save money because you can actually get a decent amount of interest for your money now. So that dampens inflation. The downside of that, though, is that if everybody stops spending money, companies start struggling to earn money. If companies start struggling, what do they do in order to make some more money? Lay people off. If people get laid off, they don't spend money, which then pushes inflation further down, which then perpetuates that cycle and more people get laid off. You end up with a recession. So whilst you need high interest rates to stop inflation, if you keep them too high, you will then create a downward spiral, which is even worse and even harder to get out of. So what they've got to do is start to move interest rates down even before inflation is back at target, because what happens is inflation will overshoot. So the rates at 5 and a bit percent that they reached are part of what's having the impact now, because it doesn't pass through instantly. And people don't then suddenly go, oh, rates have dropped, let's start spending money. Because, take for example, I'm possibly looking at selling my house and moving, but one of the reasons why a lot of people aren't at the moment, and some reason that equally I'm not rushing to, is if I think interest rates are going to keep falling, why do I want to move house and get a new mortgage now when I could wait for rates to drop a little bit further? So then that reduces my willingness to spend money, and that is something that is happening across the board. So what they're basically saying with this, if they've got greater confidence that inflation is going towards target, well, they can now afford to drop interest rates back to a level that supports the economy better. Yeah, this is their bigger worry, that what they want to do is reduce rates to get people spending again. If people start spending again, it's all good. And now the economy can once again start to grow. If that doesn't happen, then we're in trouble. S&P's back above 15 now. Just that wash out just to get everyone out. And you've got the deltas flipped over, and it's through that 20 period EMA. So there you go, you had the wash out. We can stay at these prices now, there you go. Off to the races, he says. We'll see. You'd look for it to stay above 12. So yeah, that's what's happening. They've got greater confidence, which means essentially they're more comfortable to be able to cut rates. Essentially, monetary policy is like, you might be too young, the helicopter game I used to play on a computer, where you basically had to, you had to fly a helicopter through a cave, and you press up and the helicopter goes down, you let go and it starts to drop. If you press up too long, it shoots up and hits the top. If you don't catch it quick enough, it hits the bottom. Monetary policy is like that if they raise rates too quickly, the economy tanks, and if they don't raise rates fast enough, the economy tanks because inflation kills it.
It's a lot of responsibility, actually. It's finance.
And whatever you do, everyone will think you've done it wrong. Anyway.
You'll never probably get it right, though. Never be perfect, at least.
No one gets it right, it seems. Right, greater confidence. The other thing that they talk about is risks. And again, you're looking at the subtlety of how these change. They're continuing to move into better balance. They are now roughly in balance. The past phrase from the Fed for a long time has been that risks are roughly balanced. That's all good. If risks are balanced, then it means that, again, any reason to not cut rates is starting to go away. This is a new phrase, but I don't think makes any difference. This is just their reasoning why. That basically they've considered what's happened on inflation and they've considered the risks, and on the back of that they can lower interest rates.
When they say risks, in the previous policies, have they stated what the risks are, or is that something is it just stuff we work out, like geopolitical data?
So they will at times reference the risks. So some of those risks have been related to China's economy, the Russia-Ukraine war and its impact on energy prices. They will reference them. They've referenced hurricanes in the past, all sorts of stuff. What they talk about here is the risks to both sides of the dual mandate. The Fed has a mandate to maintain price stability and maximum employment. So the risks are balanced now, that yes, inflation's high but falling and unemployment is rising. That's not a bad thing. They're reasonably balanced. You don't want unemployment too high. I'm not going to get into the economics behind it. Go and Google Phillips curve. If unemployment goes up too much, or if inflation stays too high, unemployment will rise. As unemployment rises, that will push inflation down. So there's a balance between the two.
So we're looking for that data that's going to throw the balance off.
Yes.
This is getting really interesting.
There's a lot to read on all the theory. But ultimately, you've just got to come down to the statement. There's 3 qualifying points here that matter. There's the balance question here that you're interested in. The confidence part, unless they change that, I don't think there's much to be said for that. The bit that is new down here, you don't worry about what they say on rates because that will just pop up. You're just looking for the number. What they brought in was in considering additional adjustments. That has changed from in considering any adjustments. So it was any, i.e. will they do anything, to now additional, which sets the tone and basically says we are definitely doing more cuts It's just in considering the additional ones. How many are they going to do? They dropped the previous line, was does not expect it will be appropriate to reduce rates until it's gained greater confidence. Well, it has gained greater confidence. So that line goes. And it's strongly committed to supporting maximum employment and returning inflation to its 2% target. That used to be, is highly attentive to inflation or to inflation risks, words to that effect.
The target range, Rich, where do we get that? Is that something
That will just come out in the screen dump. I'll show you what I mean.
what is the target range? Is that like
That's the rate.
the end rate, like the last rate the aim to have before the shift in cycle, or
No, it's just the rate that they are at or will be setting rates to.
in the next meeting?
Yes. So there you go. That's the line. Cuts key overnight interest rate by 50 basis points, 475 to 5. So that's your target range, that one. So the target range, what they mean is the target is what they want rates to be now or from when they do it. So from tomorrow, the target range will change, and that's where they want short-term borrowing and lending between, or lending, borrowing, same thing, between banks to happen at. I'm not going to get into these. Go and watch it on the videos, the specifics of how they actually enforce that. Because you can't just say, you guys can only borrow from each other at this or in between these two prices or these two rates. The Fed has to impact that. And the way that you impact the short-term interest rates is via the amount of money in the economy. The Fed can print money. They're the only people who can print money. So if you increase the amount of money, interest rates fall because there's more money. If you reduce the amount of money, interest rates rise. So the way that the Fed keeps you in that band is by increasing or decreasing the amount of money in the economy.
The printing more money would drive inflation.
In an extreme, yes, but they're just doing it on a short-term basis. So they're doing it, if rates start getting a bit too high, what the Fed can do effectively is go, you can borrow money from us. We're going to offer this amount of money. If anyone wants it, send us some bonds and we'll send you the money. And people look at that and go, well, I'm not going to pay a high rate to borrow money from someone else because I can just borrow it off the Fed. And that's nice and safe. So that prevents short-term rates. When I say short-term rates, I'm talking bank-to-bank rates. They're not going to start rising rapidly because if I know that I need to borrow some money and you're the only bank and you go, yeah, but the rate's 5.5%, and then the Fed goes, yeah, well, we'll lend it to you at 4.75, I'm not going to borrow the money off you, which means that you now need to lower your rates, which therefore means that market rates stay in line. Equally, if everyone's got money and I need to borrow some money, I know that I can shop around and see who's got the lowest rate. Rates will start dropping in order for people with money to earn some return on it. That's where the Fed steps in and goes, well, how about we'll give you some treasuries, you send us and take the money away effectively. So you could send the money to the Fed, and that way it takes money out of the system, and that then pushes rates up.
Are TLTROs still important now?
TLTROs, so ECB ones, they're not massively. Stuff like that is important when it gets implemented rather than when it.
But for, as you were mentioning, for interbank, let's say transactions, like borrowing and stuff, isn't it important, the interest rate that they provide?
Not the TLTRO. So a TLTRO is a ECB long-term repurchase operation.
It's not for the US, it's only for...
That's an ECB thing, yeah. The US has had in the past what they called a TALF, which is a term asset lending facility, which is the same kind of thing. The way that those things work, in short, there we go. The way that those things work is normally a normal repo, what would happen is, let's say rates starting to get high, and the Fed will then go, right, we'll offer, in fact, they might have it on here. No, so they were only doing a reverse repo before the Fed last time, but I won't go into the reverse repos. Normal repo, rates start drifting up, and the Fed goes, right, we're going to make available 30 billion at, as it would be at the moment, 5%, or it's, again, not getting into administered rates, it'll be slightly lower than that, so it'll be 4.85%, I think. So there you go, right, there's 30 billion, not euros, dollars, 30 billion. And that is for, well, if it's overnight money, right? So that's available. What that does is that pushes up, pushes down short-term rates because it puts more money into the system. The day after, you get the money back from the Fed. You get your bonds back, you give them the money back. So that takes the money out of the system again. The idea of a TLTRO or a TALF or a LTRO, as they were originally, a long-term repo or standing repo facility that the Fed has had as well, is that these are no longer overnight. With the TLTROs, I think they were 3 or 4 years. So basically what they're saying is, we will lend you this money from the Fed or from the ECB. So that's as safe as money as you're going to get. We will lend you this money at, as it was with some of the TLTROs, 0% for 4 years.
Interest,
So the idea behind that is, it's QE, but it's not, because the agreement is you will give the money back. That's the distinction between QE and a TLTRO. QE, they just print the money and buy stuff. With a TLTRO, they print the money, buy stuff, and you agree that you will pay it back. So now these are running. I think there may be some still running. They will expire at some point. The agreement's there already. You hand the money back. Chances are a lot of them will have been exited anyway, and people would have just handed the money back. Reason being, they don't need it anymore. There was so much money created via QE that people don't need the money anymore, so it doesn't really have too much impact. The bigger thing is if a TLTRO or a term asset lending facility or things like that get introduced again, because that's tantamount to QE and is often a precursor. I say often, the 2 times that I've seen it is a precursor to QE, because what they then do is they say then, because original QE 2008 wasn't QE, it was a long-term repo in the November, and then in the March the Fed said no, that's an unsterilized one. So what they mean by unsterilized is they won't ask for the money back, so the money is then just out there, free money basically. So that's what happened. So I hope that makes a bit of sense. It was not overly complex, but that's the way a repo works. That's also the way that a central bank controls the rates. And on this note, that's the way that the data will come out. So this is your screen dump. All of that info that you get on there, all the way up there, all comes out at the same time. So we'll go boom and drop. Whatever news feed you're watching, read from the bottom up, don't read top down. Chances are the most important thing comes out first, and that will be the thing that will come out and shoot down the screen. So make sure you read bottom up, unless you've got Bloomberg, and then it will hold the most important info at the top, or whatever Bloomberg deems to be the most important info.
Can we know your short segment how to set up the access time?
Yeah, well, that's what I was going to do tomorrow. So I wanted to give people some stuff to look at today to make sure that you've done a bit of prep, done a bit of reading. Tomorrow, what I want to do more is actually, what are you going to do? How are you going to actually visualize it when it comes out? What are you going to trade? Why would you trade Euro or 2-year or 10-year or S&P or whatever it is? And how are you going to go about doing it? So that's what we'll do tomorrow. I don't know why I keep getting little clicks on the computer. It's weird. Right. So that's your statement. Go and have a look at them. It's a good thing if you really want to get into trading central banks, any of this type of stuff. Go back and have a look at a large number. Go back and have a look at a large number of them and look at the way they change over time. I won't say a large number, you go back from the beginning of this year. This year's been quite stable, but there's been quite distinct shifts in the pricing or in the number of cuts that are likely to come, and that's then communicated in the statement. Grimy, in a 1 minute chart, how many days do you use? Because that will affect the EMA. It won't affect the EMA because the 20 relates to the number of periods that it factors in. So the way any moving average works is it takes the last 20 instances, and then when you get the next candle, it doesn't count that one, and then the next candle, and it doesn't count that one. So it doesn't matter how many days you go back, it's just about the last 20. An exponential one weights the value of the most recent ones more highly than a simple. Simple moving average just averages the last 20. An exponential one puts a weighted average towards the most recent, which is why I prefer to use that. So there we go. Right, super quick one. It would take a long time to understand the subtleties such as language use and context and put them together fast enough to trade the Fed announcements. I agree with that. This is not something that you'll be able to go, all right, boom, tomorrow I know what to do on the Fed and this is easy. It is probably the one thing that I would always say to people, you're never going to learn this quickly. It's experience, it's doing it and doing it and doing it. And then you're like, okay, now I know what to do. If my aim is not to be a news trader, is it reasonable to attempt secondary trades? Probably a fade, primarily on a technical order flow basis with just basic understanding of rate announcements or discrepancies between expectation and announcements. If this were done, would it require doing the actual trade differently than with a more comprehensive understanding? Okay, it's a good question. Quite simply, you can just approach these types of things almost purely technical. You've got to have an element of understanding that certain things are going to have a big impact. You don't want to get involved in it from a technical perspective. If you want to fade something, I think a dangerous thing to say is probably fading it, because if they do 50 tomorrow, you can try and fade whatever you want. It's not coming back, at least not for a while. It will be a disaster if you try and do it. You can just trade things purely technically. Tomorrow could well be one like that. If you don't get anything particularly clear, markets will probably just get on with whatever they were doing anyway. So if they're already on their way up, getting the Fed out of the way allows them to continue the technical play that they're already on. So that's something to consider.
But do they usually react as they should, like react to what the statement says, or do you get like complete opposite price action to what the statement?
No, you're not going to get, no, because that would imply people have just completely got it wrong. No, you won't have that. What you're looking for, and the best way, and this is how I started learning central banks, we'll talk about it a bit tomorrow, but go and think about this tonight, right? Rather than trying to understand everything and all of the moving parts and all the possibilities, go into it and say to yourself, right, what are the kind of outlier things that I could do? So almost create yourself, say, 3 trades, 3 possible things you could do that you could be confident what will happen. Over time, you'll start to get more and more things that you're, okay, I understand how that could happen or how this could impact and this and this and this. But ultimately tomorrow, you want to think about, are there certain things that he could say, certain policy actions or parts of the statement that could change that you could say, if that happens, I'm going to do this in this market and I'm confident of the result. That's what you've got to try and do with those. It's the best way to start. For a long time early on, after losing on a few of them, I've started approaching the Fed like that. I'd basically come in for the Fed or stay for the Fed. We were very clear, I'm doing this or this. And if they didn't come out with either of them, pretty much just went home. I didn't actually go home, but just switched off in terms of actually trading. It was basically, there is no more trading now. Just watch what happens and try and understand what goes on. To save yourself getting caught up in the melee of what I call emotional trading, not from yourself, but on the back of any kind of event like this, you get loads of people chasing the market all over the place. Oh, it's going up, it's going down, it's going here, it's going there, because they've read this, they've read this, they've read this, they've read this. You don't want to get caught up in that. You want to be able to go, this is the trade. If it happens, I'm clicking and it's going to go up there. A bit like the election yesterday. I know we're not talked about that too much. With the election yesterday, people have looked at that and gone, right, if I get an indication that Trump's winning, I'm going to sell the euro, buy the S&P, whatever the trade was for them. Get in, the decision is made and let it do its thing. That's kind of what you want to get to, or where you want to go with some of these.
So when you've got a clear policy shift, it should be a straight line move?
Yes. Yeah. If he comes out tomorrow, I can't imagine he will, but it's a possibility. So here's one example of a sort of outlier thing. If he comes out tomorrow and says words to the effect of, because he won't say it, I have my doubts about a rate cut in December, that's a pretty clear statement. As in, the market thinks they will, and he's basically just told you they won't, you will get a reaction to that. That's the kind of thing that you would look for. Nuanced stuff is going to be less easy to trade, because that comes down to how the market has moved recently versus pricing change versus what exactly he's saying and how clear it is what he's saying. So what I would do for tonight, go and have a read of the preview that I put up. I'll repost it because I appreciate it's shot off the page. I'll repost another preview as well from somewhere else. With the first one, the MNI one, it's about 32 pages long. I would read the top 2 pages, are quite useful to give you a bit of context. What I would then do is go and read the bottom, 3 or 4, where basically they give the bank analysts' views, because ultimately that's the stuff that's going to happen. M&I does a huge amount of basically giving their, they write it like they're writing a university essay. They reference everything, explain in detail every step of the way. It's not interesting actually, sorry. It's detailed. The ITC one is much more to the point. That's probably the better one to read. It's at least a little bit easier to interpret. I think the M&I one just piles the info, but both of them have analyst views, which will ultimately be the same because they're from the same banks. But the analyst views are ultimately what you're interested in, because that's what people are going to be looking at. So go and have a read of those. Go and have a think about what it is that you would want to do on the Fed tomorrow. What we'll do tomorrow is I'll walk you through my sort of thoughts on it, what you're actually going to look to try and do on the event as well. What you need to understand there is which markets move, and also to what degree they move. It's all well and good going, oh, I'm going to buy the euro on it. How far is it likely to go? There's no point in trying to get 300 ticks out of the euro on a Fed decision, because even the biggest ones, I don't think I've seen 300 ticks. So you've got to think about that bit. But we'll go through all of that tomorrow in terms of the actual prep of what you want to do on it. I'll let you guys go and have a little think about that. I'd also think about stuff from a technical perspective. If the S&P consolidates nicely up here and tomorrow on the Fed gives the chance for the breakout, even without the Fed saying a great deal, it might just go, and that could be the chance for it. So often the good thing about a lot of these types of things is even if they say nothing, the increase in volume can allow a market to go and do what it wants to do, which probably supports Darius's more technical approach. So there we go. Right, I'll wrap it up there, guys. We'll perhaps touch on the election next week, particularly when we look at correlations. So I'll bring in a little bit on the election next week for that. Until then, until tomorrow, have a good afternoon. Just on that one point, we'll do the prep session tomorrow at 11. So we'll start live at 11 tomorrow. I will get that changed on the calendar for you as well. See you tomorrow. Thank you, mate.
Stayed up last night?
Me? Oh, yeah, maybe we stayed up till 3. Yeah.
I was going to say, so